Well, what's up, YouTube? Welcome back to the Wallet Monkey channel, where we give you all the credit intel you need to grow your wallet. So today, I want to break down all the FICO models that they use for scoring. And the reason why is because there might be something in here that is actually the lead reason or the primary reason why you're getting denied for an application. I know there's a lot of stuff to look at, right? And we've shot several videos covering the second tier, or what they consider a subprime credit bureau, the different monitoring services, the LexisNexis, check systems, all this stuff, right? There is quite a bit to keep an eye on. But also too, let's not forget that within the model and the scoring model itself, there might be reasoning for why you are consistently getting denied for something. Getting denied once, would I be looking at this? Maybe not. But if I'm getting consistently denied from a credit card company, I'm gonna start to look here in the FICO models that they're pulling and see if I can get any correlation to what's going on, right? And so FICO data too, like is it pulling FICO 8, FICO 9, etc. We're gonna start to upload on the master credit card lender list as well. We've already started doing that, but there's a lot on the screen. Let's jump in and cover this one by one. So there's quite a bit of FICO models, and then there's the whole Vantage system as well. I don't cover the Vantage system that often because that's, you know, your free Credit Karma model, and I just don't put much value on that. Amazon internally will use that for the store Prime card. So Synchrony uses that to give credit limit increases, but there's not a lot of people using that as a primary pulling mechanism. There's a lot of people that'll give you that for free as a scoring model, as like some sort of perk to get the card or with a bank account. But as a primary, like we're gonna use the Vantage score system, there's not a lot out there, right? So let's stick with the big guys here. FICO 8 and FICO 9. Those are gonna be the two most common models. Now we covered FICO 10 and 10T in its own video. We'll link the card, but I'm gonna briefly go through that as well. And then FICO models 2, 4, and 5, which are all very similar and primarily used for mortgage data. So FICO 8, most common used, there's two versions of it. There's an auto version and a bank card version. Each one is kind of tailored to what you're getting pulled for. FICO 9 is the newest version that's been rolled out and actually adopted by banks, even though FICO 10 was rolled out in 2020. I just don't think anyone's using it so far. I haven't heard of a single situation or instance that's being used. Okay, and then 2, 4, and 5, right? So let's kick the screen back over and get back to right there and get back to FICO 8 and 9. All right, so 8 is gonna be more sensitive to high utilization. And kind of what triggered this is there's somebody in the community that was talking about that they kept getting denied from Chase for like, you know, month after month, year after year. And I'm like, maybe we need to look at this because this might be the sole reason then. If everything else looks good and you've been consistently getting denied, I'd look at FICO scores. And really, what is that model using and where is it putting weight? Because what's changed over the years and what changes with each model is just simply where are they putting focus, what matters on the report, and you know where the weight is put. Even though all that data is still being shown, it's just where are they putting the emphasis, right? So with FICO 8, there's more emphasis and they're more sensitive towards high utilization. So it should be below 30%, but even that I would say is too high. So they're more forgiving on one-off late payments of 30 days or more, as long as all other accounts are in good standing. AUs do not show up on FICO 8 model. So if you're trying to add an AU and then get pulled from a bank that uses FICO 8 to get in that ecosystem, might not work the same as you thought, and it might not work at all. So spending $350 to $650 on an AU when you could have just put that same money into, say, a savings account or a checking account to get into the ecosystem, that might be more worthwhile. So you need to know these things. All right, so accounts in collection under $100 balance are ignored. So this means it factors in all collections of $100 or more, even if it's paid off and showing a zero balance. So under 100, it's ignored, but it's still shown on the report. Understand, it doesn't just like delete it or hide it. It's still shown on that report. It's just in the model itself, the score model, it doesn't matter. And then all collections are shown that are $100 or more, or were $100 or more at any point, even if it's now showing a $0 balance. Make sense? And so a few banks that use FICO 8, and again, we don't have a complete list of this at this point. We will, and I'll probably shoot another video. Chase, Citibank, BOA uses FICO 8. FICO 9 ignores accounts in collections that have a $0 balance. Okay, so slightly different than FICO 8. This also, FICO 9 factors in rental history. Authorized users or AUs do count, utility bills count, and it counts medical collections less harshly, so a surgery bill in collections will have less impact on your score than a credit card bill in collections on the FICO 9 model. So that's good to know, right? And so between the two, they're pretty different. Yeah, and so you need to know these things going in, because like I said, if you've been consistently denied, that might be a reason why. All right, so FICO 2, 4, and 5, very similar. The main difference is that the 3 is that 2, 4, and 5 use data from Experian, TransUnion, and Equifax respectively, each one different. Mortgage lenders will pull one of each and compile the reports in a document called Residential Mortgage Credit Report, or your Residential Mortgage Credit Report. Duplicated data is screened and removed, and the middle score of the 3 is picked to represent your willingness to pay back the mortgage. Make sense? So that's really the primary differences. Now let's jump into and wrap up with 10 and 10T. So the difference is that now for the first time, FICO is offering a regular score or a traditional score and a trending data score. Now, Vantage has been offering this since 2017. So it's not a new thing, but it's new to FICO because the banks basically asked for it. So the T stands for trended data. So if you think of the traditional FICO as a snapshot, the 10T would be more like a short video. Also, the biggest changes in FICO 10 is that they're now going to start looking back 24 months of credit activity. And so how you've been treating your credit over the last 24 months is going to be more and more important as this gets rolled out. So your score could drop, and really the main factors that we know matter so far, because it's not like they've released this out, like here's the definitive list of what's going to matter, but it seems like this is the big areas of focus, is that if you took out a personal loan to consolidate on credit cards, that's not going to hurt you. But then if you went out and ran up the cards again, or went out and looked for additional credit after that, that's going to negatively affect you. So basically what it's showing is like, yes, you went out to get a personal loan, you consolidated credit cards, good on you, but then you ran the cards right back up and the personal loan is still open. So I assume that if the personal loan then got closed out and then you ran the credit cards up, that wouldn't matter the same way than what I just described, right? All right, if you're using credit cards to get by and you just don't seem to whittle the balances down, or your balances are growing, this means that if you're keeping them at a high utilization rate and not really paying them down, paying $100, $200 a month without consistently, like let's say a couple times a year, wiping off the balances completely, well then that starts to look bad because it looks like you're living off your credit cards, right? All right, and then the last one is if you missed a payment, the penalty for going 30 days past due will be even harsher than under previous FICO scoring models. So it's really tough, man. Like they're tightening up quite a bit on this new scoring model, because any late payment, any missed payment is going to affect you more. Living off your credit cards is going to affect you more. Taking out a personal loan and then maybe some emergency strike, so after you just paid everything down, then you run them all back up and the personal loan's still open, is going to affect you more. And they're looking 24 months back in history, right? So keep this in mind. We've covered this on a dedicated video. Again, we'll link the card up there for you to check out, but I just wanted to shoot this video because I think it's going to help a lot of people who maybe they aren't thinking that this could be affecting them in that sort of way. Now again, one denial, I don't know if I'd be looking this deep, possibly, but if you're getting consistently denied, I would actually start to look at the different FICO models and try and figure out if that same bank is pulling one of these models and what this model is then telling you about the focus of that report and that score, and that could be definitely a reason why. So then we know those things, we go to work on those things, like whether it's utilization, late payments, etc., remove those off the report, go again and see how we do, right, with trying to get approved at that bank. So anyways, I'd love to hear your thoughts though. Comment below, even if it's just for the algorithms. It means so much to get this video out in front of more people. Like the video as well as subscribe if you're brand new here. Hit the bell notification. Be on the lookout, more videos coming soon.